Morning, everybody, and welcome to this session. um, Today's topic is on um, industry-specific data, which most of us try to. Sometimes we struggle on how to get it, even though we need it in our preparation of valuation reports. And I hope that we have an interesting session today. I know that it is useful for us because, like we normally do, we have topics which are um, aimed at helping us in our practice. And thanks to Shilpa for organizing all these topics. With this short introduction, let me hand over uh, to Ravi or to Shilpa.
Hi, good morning, everyone. Today it's my privilege to introduce our resource person, Mr. Mayur Deshmukh. He has been with us since we started our association, and he is contributing very highly to our association in terms of public relations. And you see all these flyers and also all the Twitters and LinkedIn and Facebook and all is handled by him. And his background is he is an MBA, and he's the co-founder of Wheaton Advisors, and he has over 6 years of experience in the field of investment banking. He holds MBA degree from Pune University and has completed applied corporate finance course under Professor Damodaram himself from Stern School of Business, New York University. Earlier, he had an opportunity to work with Hanman and Partners, a London-based investment banking firm focused in mining industry for 2 years, where he was responsible for valuing companies in the mining industry. And he has uh, got a lot of experience in raising capital for gold mines. And also he had a short stint at Globeflex Capital, a San Diego-based hedge fund, as a research analyst, where he was responsible for building financial models for the consumer discretionary sector. And over to you, Mayur, with this introduction. Thanks for taking on today's session.
Hello?
Yeah, we can hear you.
Yes. So good morning all. I am Mayur from Wheaton Advisors. Ravi sir has aptly given my basic introduction. So now let's come directly to our topic. I hope everyone is excited about industry specific data which we require. Okay. So how many of you have tried? Can you just raise a hand in your chat section and let me know how many of you have tried valuing startups or a company where you don't get a data or a multiple? Okay. Yes. So today I will give you some basic thumb rules which I used in my professional experience while valuing various companies uh, throughout. So first of all, I was struggling to get the specific industry specific multiples which we want. Okay. And then I tried to build a database and used a paid database to get the resources. And I have summarized a few for your experience, for everyone's benefit. And I will also share some of the industry models which are standard, which are a standard practice, which are used by industry professionals. Okay. So my first question, when I was working on a mining model, I came across this chart. Can anyone of this just name which type of chart is this? Please write it in the chat box if you know which type of chart is this. No. So this chart is known as football fields in the valuation industry when we present it to the investors. So if you see, I have written few variables on which we are valuing a company. One was EV by EBITDA, which everyone must be aware about. So so they gave us a really high valuation in terms of 300 million to $350 million. Then we came to estimated EV by EBITDA. It was reduced a bit, but still it was not showing the actual pictures. And then we used our industry specific multiples to get the data. And from this, you can see there is a wide variety of valuation. And we need to finalize as an analyst or as an investment banker, which is the best rate for our fundraising. So I think it's automatically. Sorry. So our first and most important challenge in this field was how to determine this range. And based on our multiples, it was going way beyond what is expected by the investors. So what will be your thoughts? Can anyone let me know their thoughts on how will you come up with the valuation for such type of company? It's a gold mine and you need to raise around, let's say, $50 million for it, for its exploration, for its expansion. Yeah, I will just give some more insight so that people understand which should be used. So reserves and resources is nothing but what the company has in its portfolio, means uh, how much mine or else gold can be extracted and how much is there in the entire mine. Okay. Then comes a production, how much they are producing. So these three are the most important variables which we consider while valuing a gold mine. Okay. So I just gave you a brief about how the variables can change from our standard variables like EV by EBITDA or else price to earnings ratio to other industry specific multiples, which we will use for our fundraising. Now, let's come to a basic thing. Yeah, so just giving you an overview of what is enterprise value and what is an equity value. Enterprise value is a value of entire firm, whereas and it consists of debt and equity, whereas equity value is just value given for equity shareholders. Now let's come to the most widely used equity multiples. So I would like this to be an interactive session, guys. So can anyone let me know when will you use price to earnings ratio or for our valuation? Our first option will be if a company is profit making or a company is loss making. Just let me know option 1 or option 2 in the chat bar.
Profit making.
Yeah, profit making. generally we cannot use this PE ratios for loss-making companies because it becomes redundant for valuation purpose. What about price to cash flow? Yeah, it's for profit making, and cash flow is considered as a proxy for your EBITDA. So positive is always required. Now, when will you use price to book value for which industry basically? Will you use it for banking industry or will you use it for software?
Banking.
Banking industries. The reason here is for banking industries, your book value is your entire value of your assets. On that basis, you give all the loans and other banking operations. Hence, we use price to book value. When we come to capital intensive is also right, where capital is very high. And well, will you use PEG ratio, PEG? Yeah, sir. I think there is a question. Book value for real estate companies. Sir, for real estate companies, there are other ratios as well, like fund flow, FFO, AFFO, which we use. For PEG companies, PEG is used for growth companies, basically startups, and that is most widely used because growth for startup is very high. So I will just brief out each and every in simple way. Price to book value is also used for our semiconductor industry because it is more on investments. Then coming to PEG, yeah, we are done.
You, sorry for interruption.
Yeah.
Okay. This PG is, recently I read one article in the Business Line. They are widely using for all industries almost.
Sir, but
the money control, it is there for every industry. They are, they say that it is a very important one actually. But how, you are saying only for startup industries. Just I want to.
sir, most value is for valuing companies. It's most widely used for startups. Because for startups, we have different issues coming all together.
Okay.
You can use it for every industry, but in my experience, most of the people use it for startups. And if it's a really stable industry, most widely used variables will be EV by EBITDA and price to earnings. So is your doubt clear or should I?
Thanks. Yeah. Thank you.
Yeah, let's. Now comes our enterprise value multiples. First of all, why do we use enterprise value for valuing companies? Can anyone let me know that?
To just as a comparative analysis of related industry segment.
Yeah. So my perspective of this is enterprise value consists of both
You can value the total assets of the company, name it total firm, because the firms usually, firms capital structure also affects the valuation. If the firms are having different capital structure, then if you use PE multiple, you will get different sort of valuations. So if you use firm valuation multiples, so that the leverage effect can be understood, so that you can arrive ascertain the correct value.
Yeah, perfect, sir. So we use enterprise value on widely basis because it takes care of your debt and equity both. Because most of the industries, apart from IT sector, will have a huge amount of debt on their books. And whenever there is a debt, EV enterprise value makes more sense. Okay, the way we use this equity multiples, in the similar fashion, we use all the enterprise value multiples. Like if it's a loss-making company, or if you don't have a positive EBITDA, then EV by sales is used. Or for capital intensive or less capital intensive, you use EV by EBITDA and EV by EBIT. Free cash flow is again when is used as a proxy to EBITDA. And whenever you are valuing huge utility like type of companies, then EV by capacity is used.
EV by capacity now.
Like BESCOM, water supply.
The electricity capacity.
What is the capacity?
Okay, now coming to just
can you please mute yourself?
yeah. So going ahead to a industry specific multiple. Okay, EV by revenue is again used for startup companies or early stage companies who have revenues on their books. Okay, and it's used widely across the sectors. EV by subscribers. This is widely used for software as a service companies. The companies which have subscription based model. Okay, the good example would be Microsoft, Netflix, and in terms of softwares, there are many gamings which are based game applications which are based on subscription model. Okay, EV by EBITDA used in consumer industry. It's not used in banking and insurance because EBITDA value don't count much in those industries. Oil and gas is driven by other multiples like price per gallon. So what is the price per gallon and what is the production volume of the oil and gas? And in real estate, we have other FFO multiple. Coming to EV by EBITDA, it's used most widely for media industry. EBITDA, gaming, chemicals. Next, going ahead, we use EBITDA. This is nothing but EV by EBITDA is used for retail and airlines. This is most widely used for this rent heavy, basically companies having a lot of rent in their cash flows. So for that, we use this EBITDA. So it is EBITDA and a rent added to it. Okay. So these were the most widely used multiples. Now I will go back to one of the multiple. I will show you few of the models how these multiples are used. So can everyone see the screen?
No, we can't see.
No, we can't see.
And Ravi sir, can yeah, it was gone. Yeah. Yeah. So can you see the screen now?
Yeah.
Yeah. So this is an example of my life example for one of the insurance brokerage fund where we raised some capital for them. So for these companies, everyone is aware about relative valuation, right? Or should I explain it?
You can explain short. In short.
So relative valuation is nothing but valuation used by the company, valuation done based on the similar companies. So to give you an example, simple example, if you want to buy a flat, let's say in Bangalore, okay, in any area. So what we do is we go to that area, we do the survey and find what is the per square foot rate going on in that area. Okay. Once we get that, then we go to the project where we want to buy a house and then see what is the rate in that area. And let's say earlier it is like 5,000 rupees per square foot. When I go to project, they say 5,200 rupees per square foot. Then I compare it with my other parameters and then say, okay, this project is having better visibility, a good connectivity to metro station. Hence, the price is more by 200 rupees per square foot, and hence I can afford to pay. And this is how we value a simple house. So it is basically comparison with respect to our peers. Okay. The same thing I did for one of the insurance company. The company name of the company was Insure Efficient. So they are in insurance broking. So they are the broker like our policy 1-to-1. They are insurance broker where they sell the insurance policies. The challenge for me was how to value insurance brokerage companies where most of the companies in India are unlisted. The first and foremost thing I did was I went to our company house, our our database, company database, and found the most relevant peers. So can you let me know which are the insurance uh, policy companies? Means who policy 1-to-1, policy bazaar, right? Hello. Yeah, policy bazaar is there. Then there is D2C insurance. So these all are private companies. Then from where will you get the data of these companies? So the best way to get the data of filings of these companies is go to the company or MCA portal and buy the annual reports of these companies. They charge around 100 rupees per company, but that will give you majority of the data which you require for valuing the companies. So from that, you come to know how much revenue they are generating, what is their profit bottom line, how much debt they are having. Apart from that, if you do a Google search, you will come to know in one of the press release or something, if they are getting a funding, they will write about how much subscribers they have. Okay. Or else how much cost they are incurring to get one new subscriber. That is cost to acquire. Okay. So I did a basic research of all these numbers and did the valuation. Okay. So the first and foremost thing I did was our standard valuation based on our revenue multiples, EV by EBITDA, price to earnings and price to sales. And I came up with very less valuation of, say, these are the valuation in crores. The valuation came around 53 crores, 55 crores, 29 crores, 35 crores. Okay. Then I wanted to increase the valuation. What will I do? Can anyone tell me what are the ways to increase the valuation? Or else how can you explore different options? Is I went with sector specific multiples. So I found that on an average, an insurance company spends around 5 to 15,000 rupees to acquire new customer. Okay, this data I found via Google search and from paid database like CapIQ or any other. PitchBook can also give you, but it's not always guaranteed. The increased terminal value is one of the DCF assumption, and it works well. But apart from that, we investor will always ask us for market check, because everyone knows that DCF can be easily manipulated by changing the terminal valuation and terminal growth rates. So here we came up with a sector specific multiple where I just consider, I found and took the average of the industry and found that cost to acquire per customer is rupees 7,400, which each company acquires. My company is spent as having a customer base of 1,72,180 customers, which are renewing the policies on yearly basis. So on that basis, I valued the company at 127 crores. If you're
How about
still
comparable
confused,
data? How
yeah.
about comparable data in that case?
So this was done by with industry research. So for example, I calculated it for like Policy Bazaar, Policy 1-to-1, or DC is there, Akoya Insurance is there. So all these companies in their press release during their fundraising or somewhere, they mentioned that what was their cost to acquire each customer. Okay, and I took average and found this value of 7,400. It was around $100.
Okay, so it's a well-established industry metric then.
Yeah, well-established industry metric then. And based on that, we just got the valuation of 127 crores. So this helped me to justify my DCF valuations. So I did one DCF valuation, and then I did some relative valuation, and then sector specific things gave us the major thing. Apart from that, what more things which investor asked for was, how is this 1,000 this database? So who are the customers? So whenever a company gathers a data, if the data is more sorted, like what is the range average annual income? So for us, it was, we classified it as based on the majority of the sales was of motor sales, car insurance. So we categorized it based on like insurance, car insurance up to 10,000, 20,000, 30,000 plus. And we also presented that data, which helped us to get the funding for this company.
But motor, that is a very small pricing, no?
Yes.
That actually may or may not be the active customers.
Ma'am,
what I want to say is, okay, for example, when you are telling that $100 is the cost of acquiring a customer, that is for a normal policy, not a motor policy. Motor policy is quite reasonable, and that active base of customers, can I actually use that number is my doubt.
Yes, ma'am, it is always, it's not only for 1 year, right? Once a car insurance is bought, it's always for 5-10 years.
Correct,
And
but I will not. Okay, you usually annually renewal also happens, but then my actual, what I want to say is the actual cost of acquisition. What you're telling $100 is not for car policy, for a normal policy. Okay, and I may have a car policy with someone, but I will go for some other policy.
yeah,
That context I'm just trying to relate and say that, just by taking active customers of this motor, wherein you have all the details, but then the cost of acquisition of $100 into this could again be questioned is my point.
ma'am, it's backed up by industry average. So if you see like Policy Bazaar, they are spending around 15,000 rupees per customer. Even the
That is
policies of
correct.
20,000,
For a
15,000.
normal policy, not for motor policy.
Even for any policy, you have to spend that much initially. And for that reason, they can give us the discounts. And in this industry, we have a great margins.
Correct.
So for these policies, the margin goes from around 30% to 50%. So if you buy a 20,000 policy, almost 6-7,000 is going to that commission agent.
Mayur, I have another question. See, while you have costed the acquisition cost, is not there a retention cost? Because what is the guarantee that all these customers are going to stay? Because the base that you have actually taken is 172,180 active customers. So
Yeah.
is there a retention cost? And the second question that I have is, have you also discounted for the fact that these customers will eventually leave because there is going to be a competitor?
Yes. We do that. We consider that in this case, we do a trend analysis. So how much is the new customer base coming in every year, and how much is the retained customer? Okay. And on an average, we found this company is a quite old company. Like they had an history from 2008. So we were able to find that ratio. How much is the acquisition rate? How much is the retention rate? And for them, they retained 80% of their customers. Second thing was, this company specifically provides each and every this insurance. So if you go with any policy like ICICI Lombard, they provide, because they are the broker, they are not the insurance policy sellers. So they have tie up with all the insurance companies, and you name the thing, and they will give you. And apart from that, what they did was they gave some bonuses by making tie-up with like showrooms. So if you take an insurance, you get this car polish free, car interior free. So that's why people was with them for a period of time.
Mayur, I have a question to continue with Silpa's question. Basically, the companies are having different characteristics, right? Like they have different risk parameters and they have different growth prospects. When you see the customer acquisition cost may not be equal to the each company, and when it is not equal, their profitability will be affected, right?
Right.
And ultimately valuation is driven by the profitability and future cash flows and growth. And
Right.
if a company spends more on customer acquisition, their growth prospects also will be lower. So there will be a differences across the companies amongst the companies in terms of earnings, growth, and risk. These are the primary drivers of the value, right? So how do you
Right,
control
sir.
for those differences when you use this kind of industry comparable multiples? In case of a P multiple and EV by EBITDA, you can adjust growth rate, you can adjust the growth rate or profitability, or you can take additional capitalization factor so that you can arrive at the appropriate adjusted multiple. In this case, how do we adjust the industry multiple, because it is more on a quantitative parameters? So how do you do that?
Sir, here most of the time it's about how you sell the story. So for me, with this, what was sold was the data of all these 1,72,000 employees, their customers.
Yes, from the actually I do agree, but the thing is that we are on the other side, right? We need to give an independent opinion.
Right.
See, most of the time we are onto artist function. See, when we are selling the story, if you are an investment banker, we definitely fit into what you are selling, but we need to defend our valuations. Since there are differences among the companies, how do you control first? I need to explain how I have controlled those differences, in my valuation analysis.
Yeah. So the way we use like control premiums, we give a discount, and it's based on industry research.
So basically, you can adjust for the. And I'm not asking for the control premiums and control minority discounts. That's a different story. I am asking for within the comparable companies, and the target has some different characteristics in terms of earnings, revenue, and earnings growth and risk. They share different characteristics, right? How do you adjust those differences in our valuation analysis?
So there are two ways I did. One was like we give like discount of like depending upon discount or premium based on the business model with respect to the peers. Okay. And second thing which I did was we never use one specific multiple. So along with price earnings, if I get some other number, means one was customer acquisition cost, I will also get one more multiple which will justify that these factors can be taken care of.
Okay. So you mean to say that you collaborate with other valuation multiples or other sort of valuations, right?
Yeah.
Mayur, I just had a question.
Yeah.
Now, is this $100 what you have stated here? Is it the cost of acquisition, or is it the value which you are deriving from the customer, like it's the selling price minus the cost? Is it that, or is it just the cost of acquisition?
It is cost of acquisition because we need to spend a lot on marketing and getting this setting up the feedback mechanism.
So if this is the outflow, how can the business be valued based on what the outflow is?
So what we do, yeah, I got your point. So most of the times what we say is, whenever we are valuing, right? So we have a database of 1,72,000, and we are spending $100. Industry is on an average spending $100 per company. So my value of the company is like $100 is it's assumed that I am also spending, and the multiplication will give me my value, basic value.
Basically, these are certain standard things which the promoter will weave a story so nicely and try to convince the investor. We as a professional, it's definitely debatable. But then this is a one option which the promoter will always look into and try to sell his, stake, a particular stake, what he wants to dilute to the proposed investor. Because we are not in the shoes of the promoter, maybe we have all these queries. But this is one option definitely we can think and put forth to the promoter so that he will build upon and present it to the investor.
Mayur, Shivaprakash here. So is it the way to look like, say, somebody who wants to start this company now, then they have to spend 7,400 per customer. So because he has already 1,72,000 active investors, so at least the value of the company should be 127 crores.
Perfect. Same thing is what I wanted to tell you.
Mayur, but my question is it not expense-based, cost-based? But generally, when we value, we look at your revenue-based, right? What will be the revenue the company earn? That is what the value is, right? But you are going on a cost basis.
Yeah. Sir, again, when we come to this revenue and cost, see, most of these startups, means companies, go in losses earlier. So even if you have a revenue that many a times is lesser than what they are spending to get the customer, revenue is lesser than what they are spending. So we need to understand cost factors here as well.
Mayur, there are a few questions in the chat box, if you can.
Yeah.
Like Shiv Prasad is asking, if the company spends more on acquiring a new customer, it means the enterprise value is more.
And Mayur, one more question after Mr. Shiv Prakash you can address. Is it that already the deal is concluded in this case? Was it a practical case wherein the promoter was successful in convincing the investor?
Yeah.
That's the catch. Someone was already convinced.
They got 5 crores on this.
Yeah, you can address Shiv Prakash's question.
Yes. Sir, if some company is spending more, that doesn't mean that every time it will be a greater enterprise value, because we need to justify to the investor why they are spending more up from the industry average. So if they can justify it, then your enterprise value will go up.
Does it also mean that this cost is the most conservative approach because we are talking about average cost per customer and not average revenue from customer?
Yeah, it's on conservative side, but even if you go on bullish side, it won't change much, because here the cost is higher for acquiring customers than the revenue.
Mayur, can I chip in to see? Actually, in my understanding, ultimately the value here, estimated value per customer, what they have done, it is actually, though they have taken that as the actual cost incurred for acquiring the customer as a value, ultimately the company's perception is that they could generate with these customers, they could generate a value of $100 for each customer in terms of future. Ultimately, whether it is relative valuation or a intrinsic valuation in terms of discounted cash flow, it should be based on the future earnings, revenue, and growth. They both share same metrics and same fundamentals. If you can't justify relative valuation with reference to intrinsic valuation, relative valuation has no meaning. So in a sense, if they are attaching a value per customer of $100, their future earnings with reference to risk, it will be resulted in $100 per customer. That is how we need to understand. That is my opinion. What do you say?
So it's more than that in future. So I have done the DCF as well for this company, but it is bit complicated. Let me show you. So my DCF came around 126 crores. So I tried to use the standard growth rates and customer acquisition cost. Let me show you.
So finally, DCF was not given any weightage, right, in this present case?
So I presented both the cases to the investor. Okay. And it gave, so for me, the challenge was getting the relative valuation, like price to earnings, price to sales were coming low. And since we didn't had a good data, we were not able to present it properly to the.
And basically, Mayur, these days, the cost of this, as you have said, cost is $100. They feel it as very, very precious. All their new, customers, they can increase with the help of this database. There is a high possibility. That is how they view it. Any investor will see the data available as precious. So if you give just some justification to it, easy to convince.
Yes, just data is the key here. Because
Yes.
once they know, and not only data, but filtered data is more important rather than a data. So for this company, we spent some time, around a month, to segregate everyone, like who are their high-end customers, who are their corporate customers, because they had some corporate customers where they were getting like 2 crores, 5 crores premium. Okay. So for that reason, so for investor, those are the target customers for their other businesses. So
there was also a okay, there was also one more benefit what the investor would get.
Yes. So they see how can they leverage this company with respect to other investments.
Correct, correct. So it was a very good idea of yours to link this valuation to the number of customer base, right? Unlike a traditional methods, what we initially thought, we would never have got so much of valuation what you have got.
Yes. So linking and giving the data in a proper manner is what is most important thing, because these guys most of the time they want to leverage the database.
And those synergy benefits what the investor will get we may not be able to capture all of that, but during this idea we are able to inflate our valuation.
Yeah. So whenever we are going to an investor, we think about all these things, that who is the investor and what are his investments. So for that we used to do, like, I will tell you about mining. I was not involved in this company's analysis at that time, but for mining we used to do a cross holding. So cross holding is something which tells us how much each investor is investing in the company. So for example, there are 3 companies, let's say ABC. And there is an investor XYZ. So he will invest 2 crores in one company.
Request the host to mute Mr. Gangadhar.
Yeah. Hello? Hello?
We can hear you. Please go ahead.
Yeah. So we used to do a cross holding. That is nothing but that tells us. So XYZ investor has invested in 3 companies. Okay, ABC, and he has invested 2 crores, 5 crores, 5 crores. This can be in similar or different companies depending upon which criteria we give to the database. And then we used to tell the investor, like, okay, if I am raising fund for a company, on an average, you are investing 5 crores in each company. You have invested 2 crores, so you can invest 3 more crores in our company. And then we used to give them the justification that why he needs to add that 3 crores.
Actually, I am not clear. Can you just repeat? Couldn't understand like what point you want to drive.
So okay, so let's say there is Policy Bazaar. There is 1-to-1 policy. And that is Insure Efficient. Okay, so these are 3 companies, and they are going to, let's say, Angel Capital. So now Policy Bazaar wants to raise the funding. Okay. So what I used to do is I used to prepare this chart for my directors. This was for mining industry. I am just simplifying it for insurance so that everyone understands the concept. So my work was to find this 2 crore. So which Policy Bazaar wants to add 3 more crores. So I will go to Angel Capital and tell them that you are investing 5 crores in policy, 1-to-1 policy, 5 crores in Insure Efficient. Then can you invest more 3 crores and balance your portfolio by making it 5 crores? And we used to give a reasoning for him to increase the for this funding, so investments in Policy Bazaar.
Okay, okay. Like even Ola, Uber also, there was the thing like, who is the main investor, how much is he investing there? How much is he investing here?
Yeah, so this can be like same company in one sector, or it can be across sector. So you as an investment banker decide how, considering this company's investments. So if you go with like the database will give you like, for example, Angel Capital, or else let's say Sequoia. So in which all companies has Sequoia invested, and if we have a complementary businesses, so we need to prepare a strategy accordingly and justify our valuation. So that's the part of the investment banker who takes care of this justifying things.
Amount of how much amount they have invested.
Yeah.
This is a new perspective, Mr. Mayur. Thanks, because we never think on those lines.
Yeah. So this is how industry thinks. Means at least I have experienced this in mining industry significantly. And we used to use it for others as well. So I did it for some Dubai-based companies for one of the clients. So I used to prepare this chart, or else give him the investor list, which he can target.
In fact, in those private circle database, which long back we had a demo, initially, I don't know about now, initially they used to, discuss that one of their USP is this. Say, for example, I'm approaching Narayan Murthy, okay, just for an example's sake, where and all he is interested, or what is his interest. Everything that this, database used to fetch, like basically the profile of the NRIs. That also, there was one feature in that. Of course, that they didn't show for valuers, but that also was one of their products. That was actually like interesting how you said now I can relate. Suppose I am approaching some person and I know his portfolio, I know where to pitch in, how to strategize to match his other interest also.
Right. So this is thing what I use was Thomson 1. So that is the database specifically for this purpose. So it's again from Thomson Reuters, or Thomson 1 is the name of that database. Okay. So can we go ahead?
Very interesting perspectives, Mayur. Please go ahead. 1 minute. I would like to announce a short break of Mr. Ravindra, 5 minutes or 10 minutes?
Yeah, 10 minutes.
Yeah. Mayur, 10 minutes we'll give a break. Okay.
Sure.
Okay. I'll be calling you also. Okay.
Yeah. Okay.
Request all the participants to join back at 9:93. Okay.
Okay.
Where he updates his numbers on an annual basis or 6 monthly basis. And it's a really extensive list for the entire global industry as well as for US industry. So this will give us a benchmark that what our company should have a growth rate or else a multiple. Because he does a extensive work in giving this sheet, and it's widely accepted by the market. So if he gives the number, it is adopted by the market easily. So if you want anything, like whenever we are stuck with some multiple which we want, like EV by sales, EBITDA, so he gives us the standard, not the sector specific, but you get a standard multiples. Okay, and apart from that, you get the idea of levered beta, unlevered beta, which you can use for your DCF valuations. And if you are not aware how to do it, you can also get the templates from his website. So all the calculation templates, or else this is the entire model which I just always use his model to get the numbers. So if you want some calculations done, he has done everything in his spreadsheet. You just input your inputs and you get a valuation. This will help you to understand the benchmark valuation numbers. Okay. Anyone has any doubt about this? So let's go ahead with. So other valuation multiples which we generally use are, one was customer acquisition cost, then is revenue per user. So this is used like for Uber or other companies or tech startups. We generally try to find what is the revenue per user which are generating. Okay, a revenue per square feet. This is for our restaurants or else retail. Basically not restaurants, it's for retail thing, like for example DMart. So how will you value a DMart? So you get an estimate of how much revenue it is generating per square feet and how they are expanding. So that will help us in valuing and getting that multiple. If you don't have square feet, the other option is revenue per stores or a revenue per franchisee. I think we had recently seen in our group how franchisee works here, how franchisee model works, and how Burger King and launched its IPO and how it was valued. So this is one of the snip from our WhatsApp group itself, which gives us the idea about valuing a company. Okay. If we are going to value a hotel, because right now I think restaurant chains, hotels are the pick to get the valuation. Like due to pandemic, many of the hotel owners are out of money, or they want some funding, or they want to sell it. So this is a hot topic. Hence, I have picked only that amount for today's session. If you are working with a software startup, then you have a revenue per click or else paid number of clicks. So I came about, like nowadays again, everyone is knowing about Rummy, Circle, and all those things. So those type of apps are getting a lot of funding. So their revenue per click or else number of paid clicks is what is valued by the investors. Now I will go to industry specific models which were used. So these models are prepared by CapIQ and not by me, to be frank. And we use this as our standard template so that we can use this as a standard template and work accordingly. So for restaurant industry, apart from our standard numbers like total enterprise value by revenue, total EBIT, enterprise value by EBITDA, PE ratios, Restaurant.
Are you trying to show another screen, Mayur?
Yeah. Yes. I'm
so
showing.
Because right now it is still on the PPT.
Okay, sorry. Can you see the?
Yeah. It's visible now.
Yeah. So CapIQ has given the extensive list of all the models. So I will be sharing them for your references. I have just shortlisted a few of them for this session. So for example, restaurant comparables. So you can just get this template and add the numbers and you get the valuation done. Okay. So standard multiples are our EV by revenue, EV by EBITDA, and price to earnings used by the restaurants. But apart from that, what was used more by the investor for analysis is how much restaurant do they own. So these are like big giants, but for us, it will be like if we are doing valuation for a restaurant chain, it will be like 5 restaurants in a city or 10 restaurants. So how much of they owned? How much are in franchise model? And what is the same restaurant sales growth? So anyone is aware about what is same restaurant sales growth?
I think you should explain maybe.
Yeah. So same restaurant sales growth is nothing but whenever a new restaurant is open, it takes time for its publicity. So what we say is, and on an average, the time expected to get it to a 100% efficiency is around 6 to 8 months or maybe a year. So whenever a restaurant completes 1 year, then we consider its sales with its peers. And we cannot compare a new restaurant sales with an established one. So that is nothing but our same restaurant sales growth model. So how these numbers vary. So this is one of the multiple which we use. So this is not multiple growth rate. For growth rate perspective, we need to use this. But the multiples which we use here is what is the revenue per franchisee or revenue per own store. There is a question. Sir, what do you mean by similar size? Yeah, okay. It might be the answer for this same restaurant sales growth. Yeah. So for restaurants, always try to use this. Apart from that, customer footfall is one of the major thing, which is not there, I think, here. And transaction value. So what is the average transaction value per store? So if we have seen in this model, this is a good comparative analysis model where we understand what is the average ticket size of Domino's which people are spending. It's around 500 to 550. How much sales they are doing on daily basis and what is the average store size. So this helps us to get a multiple, and on that basis we can value our startup or our company. Coming to retail outlets, the retail outlets like DMart or anything similar to DMart. So how they are valued is what is their average sales per retail store. So if the
are you switching to the Excel?
Yeah.
Yeah, can see it.
Yeah. So apart from our normal ratios like EV by EBITDA, these things also are considered for valuation from investors' perspective, that what is the same store sales, okay, how much of them are owned franchise stores, and what is the sales per retail per square foot or else per outlet. It's pretty straightforward. The way we did it for that ensure efficient. The only thing is here we are changing the multiples. So there we used a customer acquisition cost. Here the cost, the variable will be revenue per square feet. So that will give us the entire revenue, and from that we do the valuation. Or EV by store, enterprise value by store, or its enterprise value by square feet can also be found for this.
But how will we get this information generally? Say, for example, now if I have to use this for any of a similar like DMart, how will I get that information? Like how many they have? How to do that research is what, I'm trying to practically implement your idea.
Yeah. So this is what is widely available. This is publicly available data. So in the company's annual report and presentation, you will find it. Just let me find it for you.
The number of outlets they have and the square feet of that particular outlet.
Yes. Just a minute. I will just show you one example.
Yeah.
So this is standard annual report found from DMart's website itself. And the company itself will give its in key highlights. What is the revenue? How many stores they are there? How many new built stores? What is the retail area for them? Because whenever we are valuing, we get all the data readily from their website, their information. This annual report or else investor presentation. This is the indicator which will give us majority of our valuation drivers.
So in this case, I have the number of stores of DMart. I also have the area what their stores occupy.
Right. See, there is how, again, we have a understanding about how is their retail business increasing. Okay, so in square feet, in number of stores, and what is their bill cut, so how much people are spending.
So if I have to arrive their thing, 7.8 million square feet divided by, I think, some number of stores
Total
you showed
revenue.
in the beginning.
Yes, revenue. So you get revenue per square feet, and then how much are they expanding on that basis, you get to know the valuation.
So what I have understood now is I have the revenue, I have the million square feet, and then I have the number of stores. So accordingly, I arrive at number of store also, right?
Yes.
Mayur, I have a question here. Suppose the DMart is giving these information in their annual report.
Yeah.
But it might be possible that the peer companies are not providing these information in their annual report. In that case, whether there is any system that these information can be taken from the public data. Every company is not giving these informations.
Sir, if it's a listed company, they will surely give all this information.
Okay.
But in your specific case, I'm just trying to think practically, how I will use your idea. We can use foreign companies also, or in this particular case, restricted to India companies.
So depending upon which company you are valuing and how you are valuing.
Okay.
So you have to take foreign if there are not listed peers. So for example of my Insure Efficient, I didn't had a good peers from
India.
So
you relied on foreign databases, foreign companies' information.
Yes.
But the circumstances in India and the world over may be different. And in that case, how to readjust our findings? That is the thing where what should be our approach in that area?
what I do is I take this now. These are all foreign investors, and then I went to Damodaran's site. Okay, got this database for US company and global company, and found the risk factors. You also get a country risk factor and other factors on his website. So which I use as a discount factor.
What information you took from Ashwath Damodaran website, like industry multiple?
Yeah, not industry multiple, but most now I got the see, I got the PS from US company, right? So now I am comparing those companies with Indian companies.
Acha, only country risk premium you took from Ashwath Damodaran.
Yes, country risk premium. Then there are some other premiums which you need to understand. Okay, there is a business risk, how big the business is, because those were like giant companies, and mine is a small. So I just found small company premium or else a discount factor which I had to add, and I have added it in my model. So my multiple, if the giant company multiple is 5x, my multiple came around 3.5x.
Fine.
So Mayur, when you were doing research on insurance brokers, no, you must have found at least some 15, 20 insurance brokers, right?
Right.
Which, but most of them will be private. Most of them will be having only private data.
Right.
So were you able to use any of that data? Were you able to create aggregates from that? Or you didn't, that was too difficult to do?
It was too difficult. I just did a simple, I got the data for 3 companies. And I did normal valuation. They didn't provide much more details. So I just got the simple EV by revenue, EV by EBITDA numbers.
Okay, so let me just explain this further, my question. See, let's say, for instance, I use an insurance broker, which is called WMG Insurance Brokers, let's say, which they are linked to some wealth managers and so on. Okay, so this WMG, because it is an insurance broker, will be somewhat similar to this company, let me assume. Okay.
Right.
It will be having some 5 crores of revenue, some profit will be there, all those numbers will be there, but it would have never done any fundraising. It has a certain number of policies, etc. So getting policy data, etc., will be difficult, but you will get only financials out of, let us say, a private circle database or any database which you use, MCA database, let's assume.
Yeah. Yes.
So how do you make, suppose you get 5 such companies, how could you potentially make it comparable? So, yeah.
So what I used to do is I used to see the database I used to take the numbers from database, and then we used to try to find out from any source. Like I tried all my sources to get the data, or else in the end we used to take an industry average, because once you know the revenue, right, you understand the company's business model. You go to their website and you understand that what is their core business. So whether it's general insurance, whether it's car, motor insurance, whether it's life insurance. And from that, we used to assume that, okay, 38,000 is the general life insurance policy, which people buy and average people will buy. And we used to divide that revenue with that number and come to an approximate number. But it's again an approximation just to tell something to investor.
Okay, so alternatively, let us say in this case, the customer is basically the insurance company for them. Let me assume that the customer is maybe us individually, but they are basically selling insurance policies of the insurer. So if will you get data from the insurer's website on what is the acquisition cost, etc.? And is there any relevance towards using such data? So for instance, let me explain. Tata AIG in our case is doing a lot of underwriting for motor and for other types of general insurance. So obviously they'll be using a number of insurance brokers. So is there some way of getting data out of such sources?
No, I couldn't find anything in my research.
Okay.
I didn't get anything. Because it's all private and confidential data, and people don't want to, means even companies don't want to disclose their partnerships with these brokers.
Or if you take, let us say, insurance, the general insurance companies which are listed, which are, let us say, HDFC, Ergo, or others like that. From such sources, again, to validate the data which we are see, we are trying to get to a valuation of, let us say, an insurance broker, which
Yes.
is acting as an agent for an insurer.
Yeah.
So insurer is the one which is listed and puts out data. So potentially that is a source of information, right? But it's difficult to get is the sense you
Difficult
can.
to get it. I couldn't find anything on these terms. I
Okay.
tried to do it, but I couldn't find anything because no one is willing to tell this or disclose this because it's not mandatory by government.
Mhm. Okay.
Can we launch the poll, Mr. Mayur, now?
Yeah.
Shall I launch?
Yeah, you can launch.
Because it is this program has CP credit hours as per IBBA guidelines. I request all the participants to participate in the poll. I request all the participants to participate. Your attendance or your CP credit could get affected in case you're not participating in the poll. And this poll report will be submitted to IBBA as well. Yeah, I'm ending this poll now. Yes, Mr. Mayor, you can just explain this and then we'll go to the next poll.
We are done with that part.
No, this question, which of the following is multiple used for mining company, no?
Yeah, so for here, EV by production is used for mining companies because for mining companies, what is produced is most significant from the mine. There will be a lot of challenges, environmental factors and other factors coming up. So actually what is produced is most important.
I have launched the second poll. Participants can raise queries also.
So Mayur, while you're waiting for poll results, let me just also ask you, there is this IRDAI website, no, which is the
Yeah.
Insurance Regulatory Authority.
Yes.
So were you able to get any useful data out of that one? Or?
No, not much. You just get an industry data, not from, so for forecasting purpose, for giving a outlook perspective, I use that data, but nothing from individual brokers perspective.
Okay.
You would like to explain the second poll or shall
Yeah.
I?
Yeah, you can go ahead. It's already explained. It's just book value, price to book value is used.
How about access to brokerage reports, Mayur, on industry? Because typically brokerages, when they look at listed companies, they do an industry research and then they probably do the company evaluation.
Yes, sir. We can use brokerage, but I didn't because client didn't pay for that brokerage reports.
Mhm.
Because
Because you
in
need to have
brokerage,
the right connections, right? That's a
yeah,
problem there.
yes. And if you are looking for a brokerage report now, I would say start with an industry coverage report. So what we say, there is one name particularly.
Initiating coverage reports.
No, initiating coverage reports is one thing. There is another name where it's a very detailed report of around 100 pages on that, only on industry. And it covers each and every aspect. So I cannot collect that name. There is a specific name which we need to put in the database.
So
And
is there
it
a
will be hardly one or two reports. You will find only one or two reports, and they will be like old, 5 years, 10 years old. But those are really good reports to start our research work.
Mhm. So is there a good broker who would, which, I mean, like for instance, Credit Leon is a lot of people use, let's say, but that's more an IT industry, let us say. So the specific brokerages are considered to be good in certain industries, right? So um, uh, how do we get access to such brokerage reports? Because that is actually a ready source of data, right?
Yeah. I can help you with like one of my client gives me the access. So if anyone wants, I will be happy to share those database. Like if you need some Reuters access, CapIQ access, or is the brokerage reports, they really sell it at very cheap, means like around $35 per report, which is usually like $200 plus in the market.
Mhm. Okay,
So
basically what you're saying is that some of these databases anyway have the brokerage reports.
yes.
Okay.
So if you go with CapIQ, you get like $4,700 brokerage reports for free. You can negotiate over that. For Icon, you will it's like per page. So number of reports you buy, it's $20, $10 per page.
Mhm.
So
So
if you
is there
had
any, does it make sense as an association, for instance, for us to directly approach some of these brokerages and tell them, why don't you send us your brokerage reports?
no, I don't think it will because they are professionals.
Mhm.
And they believe that one person buys them. So the investment bank. So for my company, the billing for brokerage itself was like 800,000 or $900,000.
Mhm.
So we cannot afford that as an even in institution.
Right.
Mayur,
Yeah.
I have a question on third poll question. I have a query.
Yeah.
So you see, no, for loss making companies, when you use P by S, it is the
Yeah.
usual no, relative valuation method.
Yes.
Is it mandatory that I should have a loss making companies as my comparables, or what would be my comparables in such case? See, if the loss making company doesn't have any turnaround prospects and it is anticipated to make continuous losses, or the losses or the profits are insignificant compared to my comparables, how do I
First of
just
all, if it is making loss making, what is the period? Because if it's like for 5-10 years plus, then it's better the company goes out many a times. So unless and until their operations are in profit, it doesn't make them sense for them to stay in business.
Okay. So in case of declining companies, you mean to say the P by S ratio may not be applicable, right?
Yeah, right.
So our early stage company which are making loss and it's anticipated to make profits, for them you can use P by S. For mature companies with declining growth and anticipated to decline their revenues and earnings, then it may not be an appropriate multiple, right?
It may not be because it's going to change continuously because uh, what is our comparison? So for example, if I am looking at Kodak's business, camera business with the rule which was there like 10 years ago. So if I am going to value that company based on this multiples, it will give us a false valuation.
Yes, yes.
No, but Mr. Mayur, my question is, when you are taking this loss-making company's valuation, this is for specific sector or in general? If I ask you as per the query, you see, in general, a going business loss-making gives a different valuation. But in case of startups, even if it is a loss-making, when you apply the other parameters, which are the appropriate one, it gives a different valuation. So you have got one loss-making, say Amazon for the time being, giving a different valuation, and another running company in losses giving a different valuation. So what is the logic of putting this kind of question, which does not give a specific picture, clear picture as a whole?
Okay, sir, when I value Amazon, what in general my perception means, when I was talking on these terms with Damodaran sir, I had same doubt, to be frank, and he was saying that Amazon and other companies, these companies were selling the story, and they were in losses not because they were actually having losses. They were having losses because of expansion. Their operations were in profit, but in order to acquire more and more customers, they were going in losses. So you need to understand.
So for the time being, let's ignore this Amazon. If you take up any other new startup, so even from that angle, if you say, so not necessarily all the startups are running their operations in profit, even if they are incurring cost on acquisitions.
It seems Mayur has lost connection.
Mayur or me? Am I audible?
Rajivji, you are audible, but it seems Mayur has lost connection.
Okay.
Yeah, so let me just ask in general, while Mayur comes back, how many of the valuers would be actually using brokerage reports? Because all of us will be having some access to, let's say, ICICI Direct, HDFC Securities, and all of them publish some research reports, right? What about you, Shiv Prakash? You use something?
Sir, I keep preferring them actually.
Mm-hmm.
So mainly the CLSA, if CLSA comes out with a report, that's very comprehensive at times. So I use as a benchmark here. That has a lot of industry related information.
Right. So far, I have not tried it, but I think that's actually a good source to get some good data out of.
Yeah, I think it has to come from a credible brokerage house. That's important because there are so many brokerage reports available in the market. So there's one website called Research Bytes actually. So it's a repository of all brokerage reports and investor presentations, the transcripts of all management interviews. You can subscribe to it. It's a free thing, but it works only based on we also need to contribute, or any publicly available information we need to upload there, and we'll get credits. So, and we can also access. It's a very good repository of brokerage reports.
Research Bytes, you said.
Research Bytes.
RESEARCH BYTES.
Yes, sir. Yes.
Okay.
Mr. Mayur is back. Mayur, can you hear us?
Yeah, sorry, there was a power failure at my end. So
yeah, and you can also discuss with the participants about the last poll question.
Shilpa, since you would have lost connectivity, the last poll question was the one which had PE as the, was that the one?
Which of the following is not a multiple used for valuation? EV by sales, PE, EBITDA.
So EBITDA is just a number and not a multiple. That's why we didn't use it. So EBITDA is the right answer. Yeah, I think I was saying something. Can you just repeat the question? I just forgot.
My question was that in case of loss-making companies, earlier we were talking about Amazon.
Yeah.
Even if we ignore the Amazon and we take any other startup which is a loss-making, even if they are incurring loss, and that does not mean necessarily that they are earning profits, and that is how you can filter out that whether they are earning profits or not. Now, comparing that particular criteria for the business as a whole, how far is it advisable on, because on one side you say that this is the ratio, and on the other side you say that for growth companies other multiple should be applied. So don't both of these go contradictory if we apply in one context and if we apply it in other contexts?
So we generally never use one valuation multiple for valuing a company. So
yes, loss making. I'm specifically referring to loss
even
making.
for loss making, what will be used is what is the customer acquisition cost. First of all, they will understand. We need to find the reason why it is loss making, whether it's customer acquisition cost, or are they in operational loss, or how are they going to come in profit going ahead? Maybe a synergies with other company or something like that. So once we find that, we find a specific multiple for that. The way we say Uber is in loss, loss, still it's valued in billions, right?
Yes,
so
exactly.
Their valuation is customer acquisition cost, or else cost per subscriber. So what is the retention rate? How much riders are taking? So for example, from Uber, the investor will also take this data. Like you have 1 crore users, right? In all over world, 1 crore people use your app. How much of them use in an year? What is the use frequency? Have they used like on an average 6 rides in a year, 12 rides, or 15 rides? So that is all considered while valuing the final for final rounds.
Same was my question. You see, on one side we are talking like this, and on the other side, the majority of us are of the view that loss making should be valued on the basis of sales. Profit divided by sales.
Yes.
So, loss making, if you value on this basis, then you can never get that kind of value.
Right. So we will not use that valuation.
Yes, but here the majority of the those who polled were giving the opinion that it should be like this.
Yeah. No, sir. To be frank,
in general, you are trying to say, in general, it should be like this.
Yeah, in general, it should be like this. These are exceptional cases, and in that cases, we just keep those numbers away, because we only show what we want to sell.
Okay, thank you.
So even if you are, so I will give you my own experience in my mining domain. When I was raising funds, I always showed my company is better as compared to the peers, and found only those peers from which my company is better.
Exactly. So that is how you sell your story.
Yes. Because that's all about how you present here. Sorry.
Thank you.
This is again a practical case which I did. So here I was raising funds for this M&A opportunities for Centamin. So I just found those companies which are less attractive than this company and presented them to the investors. So it's all about how you play your story and how you want to value it.
In that case, Mayur, the investor may also be smart enough to counter question you. What about the other peer companies which you have not covered in your report? So in that case, your decision or your proposal may be put to question by them. Don't you think that?
Yes, sir. We need to prepare a story for that as well. Why dividend? Because we will always find some or the other reason to remove the company from the peer list.
That story is to be made first, Mr. Rajkumar. That
Yeah.
story is to be made first. That how to counter the investors, because they come fully prepared with the help of all kinds of valuations.
Yeah.
And sir, it's not only investors sitting there. They have their own backend team which does the research, so like the way we do.
Exactly.
Because I spoke to investor in San Francisco around last in 2019. So I was there on some startup battles where I just went as a silent spectator. I was not doing representing anyone. There I found that these guys only invest target. So even if they get 15 companies or they get thousands of pitch decks, out of that they find 12 and only one is selected for investment.
Right, you are. And that is how they invest.
Yeah.
So they are having resources to invest in this kind of valuation business first, and based on that they derive the conclusion, and then they go ahead and to top it all, you see, they have got a list of clients where they can invest, and the best one they select.
Yeah. We have to know what is best and what is the synergies with their investments.
Correct. Thank you.
Yeah. Let's move ahead. Industry specific comps. So we did restaurants, we did. The next comes our hotel and gaming industry. So this was in gaming, it was specifically for casinos. Okay, I took it from database, didn't do anything much, but wanted to give you a highlight about what are the multiples which we use. So for hotels, we always use what is the occupancy rate, how much occupancy is there. Apart from that, what is the average revenue per room? These are the two most important valuation parameters we use. And again, which are own properties, which are leased properties, but not much significant. It's just for an understanding that going ahead, what will be the cost that investor will be bearing. And last is the internet and media. So these are like our apps.
I have got a question here. Can it disturb?
Yes, sir.
Okay. My question is very specific. When you say the lease property and the owned properties, there are two components involved in it. One is that if you go on the basis of the lease properties per room revenue basis, that gives you a different valuation. And to that, won't you add the valuation of the real estate value, which is owned one? You see, one is the leased one is the owned one. If you calculate the value on the basis of revenue per room in case of leased property, that gives you one valuation. But parallelly and simultaneously, rather I should say, if you have got the owned one also, so that component of owned one, won't you add to that value to derive the correct value? Otherwise, it will give you two different pictures.
Right, sir.
Supposing I have got two hotels. One hotel is on lease, which I am running, like Oyo, and one is my own. So if I have to arrive at the valuation of this business, so one is on the basis of occupancy revenue per room for both the hotels put together, and add to that the valuation of the property, I mean, whatever you might call it as investment in land and building of this one, that will give you the correct picture. Na?
Sir, it is assumed that both of them will have the same rent, because in Pune, whether it's a not even so, if this was specifically for US, and in US, the leased and owned property rentals will be almost same. And even in
There
India,
are two. I mean, I'll add to my question little another angle. One is valuation for the purpose of raising fund. One is valuation for the purpose of selling, transferring the property as a whole. If I want to sell it to you, So what way you will derive the valuation in this case? I'm
So
selling
if,
it to you.
yeah, so I will see. So there are two things: whether the lease is of 99 years or something. We need to understand that because in long run, our revenue, our pricing will factor in all those numbers. So if it's an own property with inflation, considering the historical trend over a period of time, my cost will go down. But in lease, it will keep on increasing. So I think
I could not explain myself correctly. What I'm trying to say is that I have got two hotels and I am valuing it one for the purpose of raising money, which you say based on the revenue per room. Second is I have got two properties and I say two hotels which I want to sell as a business as a whole. In that case, after arriving at that value, which is based on revenue per room, won't you add the cost of the, the value of the building which I own? As a whole, because otherwise that investment of mine, which is in real estate, will go down the line. And it would be negligible. And whereas when we see this PSUs, which government is disinvesting at the moment, what they do is they sell the part. One investment they do on the basis of the shares which they sell going as per the market rate, and the other way they do is that they retain the fixed asset part or land component apart from that, which they monetize separately by selling it separately. You would have heard it many times that PSUs, when they go for disinvestment, they do it in a different way. Based on their share value, they sell this part, they do the disinvestment, but in that, they specifically say that this much of land is not part of this offer.
Yes, sir. So,
and that they monetize it later on when they sell it separately.
To be frank, I don't know. I haven't.
Rajiv ji, as I understood you, you want to say that those assets which are not forming part of the actual business of the company is being monetized separately, and the business is being valued as Mayur has explained. So these two parts are definitely need to be added when the valuation is to be done. That is what I could understand from the discussions with both of you.
I wanted to have his view on this because this is what I was thinking, and I wanted to have his view on this, or other participants if they are there who can help us.
I think that the point which is being made is that suppose, let's say, for instance, you have a hotel where the building is owned by somebody else and it is let out to the hotel management company, for instance, which is a typical model in hotel industry.
Yes.
And alternatively, there are owned hotels. So see, I think it is somewhat different as compared to other industries where the entire business can be shifted out of a building. So if the entire business can be shifted out of a building, then the value of the business lies in the cash flows generated by that business, considering a cost of rent. Whereas in the case of hotel industry, I don't think you can shift the hotel out of the building because there is something which has been built based upon the hotel being in that particular location and built for purpose. So the only thing here is that what is the rental which it is supposed to get? The value of the building is equal to the rental yield which it will get, I would believe. And I think Raj Kamal and maybe Rajiv, you can also consider this, that the rental yield is what you would value the building as. Okay, so regardless of whether the building is owned or leased, there is a value to the building. But in the hotel business itself, you would have to consider the rental from the hotel as a cost which is there for running the hotel. I would believe
I am giving the live example, and same it goes with the restaurants also. You see, like a franchisee of this McDonald's and all that. At times you are owning it. At times you are taking it on rent. That is how you do the expansion. So when you are arriving at the valuation based on the rental, per store, if we take it in case of restaurant, or per restaurant, So but that is either on the basis of footfalls or on the basis of the number of customer, whatever way we decide. This is one part, and we decide it and we arrive at the valuation. To top it all, won't you like to add the cost of the building, whatever investment is there, when it is for the purpose of selling? I said arriving at attracting the investor is one part and selling it another part. As I give you the example of this disinvestment of PSUs.
One
Please,
thing.
please.
Means what I think from this perspective is, whenever we take into consider these factors. So if we are using a multiple, it's already taken care of. That's what I think.
This is what was the query precisely. I mean, whether the owned room one, in case of owned property, different valuation, I mean, different multiple, and the room rental per room, revenue per room is a different multiple with owned one and rented one. Anyhow, let's go a little further.
Rajiv,
So
let me just give you one example of a business which I'm looking at just now, where they are actually running an educational institution in that building. Now, regardless of, see, obviously because they are owning the building, the cost is really not built into the business, right? The cost of having the building and using it is not built into the business. So therefore, when we are valuing the business, what we are doing is we are taking a rental cost for that owned premises, because we are saying that regardless of where the business is run, whether it is an old building or it is in a rented building, there is a certain value to the business. So we are trying to separate out the business value from the value of the real asset, of the real estate.
Real estate, yes. Yeah. So that is what exactly it comes out to be. Now, ultimately, at the time of selling, it has to be added. If at all you have to arrive at the valuation.
Yeah, but
at the time of selling.
The only caveat is in the case of hotel, no? How you will separate out, because the hotel has a value because it is at particular location. That's the only issue with the hotel. Right? You agree with that point, I think. How to some separate out the value?
Yeah. To some extent, yes. But if we go with that valuation, perhaps the value of the hotel itself comes out to be at times more than what it is the total valuation the business is giving. So in that case, it goes at throwaway prices, which is the case in case of distressed assets under insolvency.
Yeah, you're right. That is what has happened in Delhi recently, where they have sold hotels. They sold it for real estate value rather than for hotel business.
Yes.
Yeah.
And
so which is highest and best use.
Yeah. Yes.
So over to you, Mayur. I think that's.
Yeah. Then comes our internet and media thing. So these are again listed companies, but being Bangalore a startup, we have a lot of game and apps coming up. So there, what we generally see is what is the average revenue per click, or else what is the traffic acquisition cost. So what is the cost for adding Google ad and all those things, and how we are going to monetize it. So we can just use that multiple to get our valuations.
Are you referring to any presentation also? Please, we are not.
It's an Excel, only an Excel.
Okay.
So,
I think they're saying the Excel is not visible, Mayur. That's it.
Okay. Sorry. Yeah. So for is it visible now?
Yes.
So for apps and games, we generally take what is the average traffic coming in, what is the cost to attract the traffic, what is the revenue per click, or else even for e-commerce, we use the same logic. So I was working for a Dubai-based e-commerce where they were spending a lot of cost just to create a value on customer acquisition. So that multiple helps us to get a sense of what is the cost, and from that day, how much revenue can be derived is what they were deriving.
One more question, Mr. Mayur. When we are doing, say under Companies Act, requirement is there that you have to have a valuation report. We have a DCF. Okay, and whatever value, like in your first case, your valuation under DCF was less, but you got a very good value by taking some other base. So can the valuer consider this, and will anyone question any of the statutory authority, anything in your experience? Or suppose you were approached, now your assignment was to arrive at the actual value of the company and maybe for negotiation. But in case you are approached to present a particular valuation report under Companies Act, or say for example FEMA also, and you take this as a base and issue the report. FEMA, RBI is also very active. Income tax authorities are also active. Suppose merchant banker gives the similar kind of valuation and income tax authorities question, or CA will give and RBI will question under FEMA. Any of your experience, can I use the same base there?
I think we should be able to use. To be frank, I never came across such thing. So I don't have
Actually, Mr. Mayur, we can't hear you. The voice broke. If you can switch off your video.
Hello? Is it audible?
We lost you in between. Can you switch off your video?
Yeah. So basically, I never came across such things. So I wouldn't be a right person to speak on this. Because I think ideally it should work. Because it's logical and it's backed by all the proofs. So even if we say Damodaran, it's always backed by like n number of companies. So he always says that he has used 50 companies, 100 companies to come to that value. So we can always go back to that database and get and tell them. And if it's with industry accepted number, then I suppose they should accept it.
Any of the participants can also throw light on their experiences with FEMA authorities or IT authorities by using a different base other than DCF. So we all could be, after some time, we all will share our experiences then.
Yeah. So that's it from my side, covering some of the industry specific numbers. Anything you want for specific industry, let me know. I can just get back to you with that.
I hope there are no more questions from the participants. I request Mr. Raj Kamal to convey formal vote of thanks.
Good morning to all, and thanks to Bangalore Valuation Association to giving me the opportunity to offer a formal vote of thanks. Mr. Mayur Deshmukh has brought very interesting perspective to the industry multiples, and particularly the valuers which we have started this valuation profession very recently, say last 2 years, but we have not come across such databases, and we didn't have the opportunity also at the moment to use these multiples and the perspectives which he has brought to our knowledge. That is really very useful, and it gives all of us to see the things with different magnifying glass, so that we can present the valuation of the companies to the base of the industry uses. And I also thank to the Bangalore Valuation Association to bringing the platform for knowledge sharing, and that too very unique participations by the different industry, different fellow professionals to bring the different new things to our knowledge. And I also thank the Association of Certified Valuers Analysis to tie up with the Bangalore Valuation Association to give us CEP hours platform also. So that is also very useful to many of the IBBI registered valuers. They are struggling to get the knowledge as well as CEP hours, both things on the same platform. So this is really very useful. And one thing Bangalore railway station is doing, that they are choosing the time at 8 in the morning on Saturday. And those, some may be finding it very inconvenient, that is the morning hours for many other practical things, but definitely as a best utilization of time, that is the learning aspect which every person should have, that they can manage the day in a very, very useful way. So with these words, I thank all the participants also to giving their time, and also to wherever possible they are interacting with each other. So it's a very good platform. And that's all from my side. Thank you very much to all.
Thank you, sir.
Thank you, sir.
Thanks all.
Thanks, Mayur.
Thank you.
Everyone, thanks for your feedback.